This is the Legacy Wealth Code podcast, helping you build long-term wealth and a lasting legacy through real estate investing, tax strategies, and motivational stories from some of the most successful and influential people out there. Here are your hosts, real estate investor and entrepreneur, Michael Notbaum, and real estate investor and attorney, Andrew Hook.
Hey guys, welcome back to another episode of the Legacy Wealth Code podcast. I'm Michael Notbaum here with my partner in crime, Andrew Hook.
Hey guys, good to be back. It's been a little while, but we're super excited about our guest today.
Doug Schmitzer is here, arguably one of the funnier guys I know. Got a large background in the mortgage business and real estate, really. I think that's where you started. So just want to talk today about what's going on in the market, some of the uncertainty, private money that you're working with, and kind of what your outlook is. So welcome to the show.
Thanks for having me, boys.
Absolutely. Glad that you could join us today. And so why don't you jump in and give us a little bit about your background, how you got started in real estate, how you made your way to Tampa, and what you're doing now.
Okay. So my background was at 21. I graduated college with a real estate minor and started selling real estate. Right. So I get into real estate. I was also bartending. Wasn't a lot of people back then letting 21-year-olds sell their house. Right. So I got into real estate up there. Really developed that business. At that point, I had people's parents, my friends' parents that were downsizing, friends buying, they were upselling. So it was a very good market. Loved it. Thought that's what I was going to do forever. Then I came down here one weekend, went out on my brother's boat, who was living down here for like 5 years before me. Went out to Shell Island, drinking beers in January in the water, having fun. Saturday, go to Gasparilla, kind of like I mentioned when Gasparilla was really Gasparilla. 750,000 people having a great time. Remember, I'm from Bucks County in Philadelphia, where it's cold all winter and gray.
Yeah.
So then that Sunday, I go to the Super Bowl, and basically my brother's like, "You should move down here. You should live here." And I'm like, "I can't move from where I'm at." Land in Philly. 3-day-old snow everywhere, dark, gloomy, cold. I'm like, I'm packing my crap.
Reconsidering.
Yeah, so that's when I moved
back
down
on that plane and head back.
Yeah. So my girlfriend, who's now my wife, came with me, and then basically when I got down here, we had talked about, we got married and started talking about starting a family. So that's when I got into mortgages, so I could handle things.
Did you start with a brokerage down here, or did
I
you
did.
Go straight in, on real estate?
No.
Okay.
No.
You never did real estate in Florida. The real estate sales.
I had my license.
Okay.
I mean, I did do some sales for a while, but, basically when I had moved down, my brother had a company, and he's like convinced me to move down here. So that's where I started. And then, of course, gravitated back to my natural path.
Okay.
So I went and worked at a company for probably a year and a half. Was running their lending tree department, which was the old bait and switch technique, So I didn't like that. So I was like, I'm going to start my own company. So, Brett and I teamed up and started American Fidelity.
Okay.
So
that's great. So let's jump in and talk a little bit about, you've been through several market cycles now.
Mm-hmm.
You've seen a lot, obviously, in the industry. You're in the rate world day to day. I love when you and I talk, you always explain it as you're like, it's a live market. Like it doesn't matter what you think today or tomorrow, it's a live market. We're changing. So obviously you've seen a lot of changes in the last 12 months ish. Talk a little bit about how you think mortgages have changed, where you think rates are going in the foreseeable future, and some around that.
Well, rates are at the highest they've been in, 20, 25 years, I think you've got a whole society of people who have bought and ready to sell and buy again that have experienced rates in the 3s and 2s for the 15 years, and they're like, I'm just going to wait for rates to come back down to 3s again. I mean, a normal market, I'm going back when milk was a nickel, right? When I bought my first place, 6.5 was a good rate. It's just, and when this started happening, when rates started kicking up, I thought it would shut things down because people usually when rates wait for rates to go down, right? But it pushed sales further because people I have to get in was kind of abnormal. Usually it takes a while for them to adjust for those rates to level out. People I need to get in before they go higher. So we had that push, and then after that, now when you're talking about rates, today, 7.5, with 20% down and great credit score. If you're buying $1 million home or whatever, it's a huge difference in qualifying power as well. So,
But yet somehow there's still people buying these houses. You know, like you haven't really, at least in Tampa, I'm sure different
Certain
markets
markets.
are going to have seen or experienced different things. But this market, maybe it takes a little bit longer to sell the house now, but people are still buying. And I haven't seen a huge, you know, you may see some price decreases, but it's not drastic by any means.
So I was at an event last week, and it was a panel of developers that do work throughout the state of Florida, and one of them made the comment, we don't understand and we can't figure out the resiliency of Florida. And he's like, it doesn't, you know,
doesn't make sense.
It does. I mean, there are some factors as to why it could make sense, obviously, but when you look at it on a larger macro scale, it doesn't make sense.
Well, when you land back in Philadelphia and you see the gray snow,
Turn around and come
come
back.
back to Florida.
There was an article the other day that said that basically the value of real estate in Florida's only second to California now.
Wow.
We've surpassed New York.
Wow.
So, you know, that gets into another point where we were talking about how people maybe are waiting for rates to come down and buy, you know, to purchase. And we had mentioned before that, hey, you know, when everybody gets off the sidelines and rates do come down, the prices are going to go up. You're going to have multiple bidding wars. People that with the cash are king.
Be right back to
You're
where
going to
we
be
were.
right back to where you were. So you might as well buy now if you can afford it. And then you have the real estate when that price goes up and refinance.
Well, yeah. What's the phrase?
I-
Marry
Marry
the
the-
home, date the rate.
Date the rate.
I hate that phrase, but it is accurate, I feel like. But man, I hate that phrase.
Sounds like it's a sales pitch, right?
Yeah,
but
sure.
but the basis of it's true, you know.
Yeah.
There was did you guys see that show Linus?
Yeah, I liked it.
Okay.
Really
What
good
is
show.
it?
So it's a show. This is Amazon or Netflix?
I think Paramount.
Oh, Paramount. Yeah, I think it is Paramount. It's like a CIA type Navy SEAL situation, but Nicole Kidman has a husband in that show that kind of sits in the dark and watches markets. He had a great quote in that. I don't know if you remember this, but he said, I get greedy when people get nervous.
Mm-hmm.
I get nervous when people get greedy.
Yeah.
So there's always an opportunity to, you know, capitalize on these challenging markets.
That's the one thing I go back to, that same thought, where when we talk about, and I hear that all the time, well, everybody's waiting on the sidelines. Everybody's going to jump in when something happens. Well, I think the reality, though, is when that catalyst event actually happens, whatever is going to trigger that, I think, is going to be a large enough event that's going to scare people, where, like, they might just say, well,
I'm going to wait for prices to
we're
come back
going to
down.
hold on now, you know, and it's like, that's when I think you really do need to double down and be like, we're going all in on something. So.
Well, I was in a networking group for a number of years, and it was like in the beginning, you know, you're trying to kind of get your foot in the door with everybody in the group, and, well, you know, the market's been really hot for a while, so I'm just going to hold off and wait till it comes back down. And now it's like, well, now the interest rates are too high, so it's like, when are you going to jump in? Is the question, you know, what are you waiting for? Because you're either going to, like, now all those people that could have bought and got it in the threes, interest rate wise, now you missed the boat. So now the prices are the same as they were, maybe even marginally higher, but now your rate is 7.5%.
That's, you know, another sales pitch or whatever your realtor used to be. You know the best time to buy? When you need to buy. Right?
Yeah.
So if you can afford it and you can get in, because you're going to get the appreciation.
Yeah.
Right? The people that are kind of screwed in this whole market are people that are first-time home buyers coming in. Right? I mean, we had that Hometown Hero product that they opened up to everybody because the funds weren't being used.
Yeah.
And then the funds were gone. Right? It was an amazing product. 0% second loans. People are getting the houses for a couple grand, and it really helped the first-time home buyer. But that also based off of median income, which doesn't apply as much to this area.
Yeah.
You know, that applies maybe out towards the Nonasassa or Zephyr Hill, you know, a little bit further out, although Lakeland is popping up now.
Sure.
But, you know, basically the people that don't have something, that are just entering the market,
Yeah,
it's tough for them, man. They don't have the fake money, not fake money, but the appreciation to put down on the equity to put down.
I was having a conversation the other day. It was, you know, there's sort of this mindset now of, do you get stuck in your first home too? Because you can't,
Yeah.
you know, you can't move, and you're almost priced out of the larger scale up. So
That's the supply and demand problem right
Yeah.
now, right? Am I going to move out of my house? I have 3.5%,
Right.
and go overpay for another property and get 7.5%.
Yeah.
You know, it's just, you know, it's funny. I thought you'd see more of the. It's just, I guess, with the equity position, you know, FHA loans are assumable.
Yeah.
So there's a lot of FHA loans out there on properties that are assumable in the threes, but you just have to have the money to put down for the difference of the equity that was
So I don't know a ton about the assumable loans other than the fact that obviously you can step in as like the replacement borrower, for lack of a better term. And the only ones I've actually seen in my day-to-day are on the commercial side. But I did one not long ago, and it didn't make any sense to me because they did an assumption, but they adjusted the rate.
Oh, I didn't see that.
How does that even work, you know?
Maybe there's an adjustment of rate for the assumption?
Yeah, which I mean, something enabled them to be able to do that. But in most,
Page
my
36.
understanding, in my understanding, in most residential assumptions, you're getting the same rate. It's not they can't change that term.
I don't. It's not like I do those on a
sure.
regular basis. You know, I just know that they're assumable,
Right.
and it could be a little sweet spot if people had the money down. Because you remember what 5-6 years ago, you know, PMI for FHA wasn't on every loan. You know, if you have that 78% LTV on that property, the MI goes away.
Sure.
Or PMI on FHA. So those loans might be a pretty good selling point for some people if they have them.
Yeah.
Because it became permanent for the mortgage insurance after that.
Right.
No matter what LTV.
Well, and the thing that we talk, a lot on this podcast is all related to real estate investing, right? So, what we've been discussing is typical residential mortgages for maybe your primary residence. But when you think about, as much as interest rates have gone up, you do quite a bit of private, you've got your private money contacts. Those rates, yes, they were always 12%, 10 or 12%.
Mm-hmm.
They haven't really gone up.
It's crazy, right?
Right. So
because prime's 8.5 and hard money
is still 12.
Hard money's coming down. From what I've seen, because so many people took their money out of the market, the stock market, and they're basically, I've always said, with hard money, it's a great thing to do because you have an asset backing up your investment.
Well, especially if you're careful enough to underwrite the deal, so you've got a huge barrier of protection. Like a good buddy of ours has his own hard money company, and their average LTV is like 56%.
Yeah.
And so we actually had him on the podcast. He said the most profitable deals we ever have are the ones we have to foreclose on. And we literally tell the people, just sell it yourself. We don't want to take this equity
sell
from
it
you.
and pay my loan off.
Yeah. But those rates are still, his rates are the exact same today as they were when the rates were in the threes, for primary residence.
Yeah, I've seen them actually come down because the market's flooded with more investors. I mean, we loan out our own money. My friends, we loan out. Now, if you're going to go institutionalized, you let them underwrite it. But you're right.
But then you're going through the underwriting as if it's a regular loan.
Yeah, they all advertise the same, easy. It's not, like when we do it, we look at it. I'll go out and touch it, see what the value is, look at the comps, and then basically do the deal. I mean, you do the paperwork for them.
We just did a DSCR loan that literally we were like pulling our hair out. We finished a flip. We're keeping it as an Airbnb. So transition. I mean, it was so stupid.
They're pretty easy.
You would think.
This was a nightmare. It felt like a conventional loan. I mean, like a consumer.
Is it because you're doing short-term rentals with it?
I think there was a combination of stuff that was on this one, but it was long, it was cumbersome. I mean, even yesterday I was dealing with it because they said, well, the wire that you paid for we had to bring cash in on it.
Okay.
And they said the wire that you wired out is not the account
that you used to verify reserves.
Yeah. And I was like, it's still my account. It's just a different bank. Believe it or not, I have more than one bank account.
Yeah, they probably so they are underwriting like conventions. Yeah. They're like, hey, you could have put mattress money
in
that
account. But
if
you got their flyer.
But we already verified it. So like even on conventional like UWM stuff, they don't care.
Yeah.
You've already verified you have the money. You can send it from wherever.
I was like, this is crazy for what's supposed to be.
Yeah.
The
flyer. Close in 48 hours. Easiest process of all time.
Yeah, but they got you in. That's what happens with those, right?
Yeah.
You did close with them, so they're like, so they get you in the door. But we've been doing a lot of DSC, or debt service credit ratio products, and I got to tell you, I mean, you're going to pay a couple points, which you're going to pay anyway for hard money and everything else. The last one I did was below 8.
Yeah, so that's.
I mean, you go conventional with you, and then you went through your tax returns. And if you have other investment properties, and want all that information and everything else, you're going to be at 8.375, paying a point anyway. I mean, that's why they're so popular.
Right.
So go back to your comment a second about rates coming down because we're coming off of a mastermind this week that had a number of
That's unfair.
of private lenders at it.
We got to
And-
meet Hulk Hogan. Side note, that was pretty cool.
Well, you did. I missed that part.
Oh,
but-
yeah.
Are you better for that?
Yeah, I feel like a better person now.
But one of the questions posed to the crowd was, is anybody increasing rates to account for the fact that, that bank money has gone up? And the resounding answer was yes. So most people they weren't going up an alarming amount, but they were going up, 1%, 1.5%, that type of thing on their private money. So I'm curious, you're saying you're seeing the opposite. I'm just go back to that
There's a contact that has approached me that I have not dealt with before.
Yeah.
But they're going at 9.
Wow.
And they'll do a 30-year fixed.
And
Which
you're-
is crazy
and
because
you're-
prime is 8.5, right? I mean,
Yeah.
Why would?
Because they want the investment. That's a 60 LTV, right? So you're pretty secure in that. Has to be in an LLC. But, you're basically getting 9% on your money.
Yeah.
So, I don't know. I mean, you get average 6 to 8% in the stock market. This is backed up by an asset. And he wants deals. He wants volume, so he's going to undercut the rate from other people.
Yeah.
And that's on the other side of the state, but they'll fund.
What are they charging origination on?
1.
Wow, that's pretty solid.
So I got to charge on top of that.
Yeah.
Well, duh.
It's not a hobby.
How else are you gonna fund? How else are you gonna fund this life you've got? Which
Yeah.
we'll talk about later. But yeah. I mean, the Super Bowl, Gasparilla.
That's right.
That's just where it
That
started.
was 20 years
I
ago.
know.
Yeah. That's probably the most epic weekend I think I've ever heard.
Oh, I got others. Those are the ones I told you about.
So, we chatted real briefly before we started the podcast, but like, what's your take on kind of, and I think some of this parlays into your comment about people staying in their homes, right? So, which makes sense. I mean, you put me into a 275, and I had a call with my financial planner the other day, and he looked at that and he was like, I don't ever want to hear that you're making an additional principal payment on that loan. And he was like, never
Put your
pay
money
that-
somewhere else.
Never pay that thing off. And it's
Yeah.
it's funny to hear that now, but the point is we're seeing some of these products come out that are like now third mortgages as hitting the markets, or what I'm seeing, these home equity agreements that are kind of parlay like a home equity line, but if you don't necessarily qualify on the line, then they're giving you a chunk of money for exchange of some ownership in the property, which is its own animal and its own beast. But if somebody's locked in their home and now you've got to create these avenues of tapping into that equity, what's your overall take on that? I mean, that sounds some alarms off in my head, but I'm also tend to be a little conservative, especially on your primary residence with that type of stuff. But what do you think about all that in the grand scheme of things, in big picture?
Well, I think that our prices are here to stay. So tapping into that equity is not like back in 2008 through 2010, where you had the negative AM loans and financial crisis and everything else, and the values dropped. I mean, you just saw that our value of real estate, it's an article, I've read it, and, the validity has to be there, I would think. So, I mean, tapping into the equity in your property, it depends what you're going to use it for. If you're going to buy other properties with it, if you are, listen, the insurance stuff right now, you got to put on a new roof.
Yeah.
You got to do this and that. There's no way, even if you showed someone a hybrid of 2.75 and 8.75, to try and refi, it's not worth it.
Mm-hmm.
So, the good thing about the HELOCs is it's a per diem charge, right? So if you borrow it and pay it down, it's not like you're fixed in at this amount. You can pay it off. You can move around. People need flexibility. I just had somebody that was doing did it on their house to buy a property cash because they knew it was just easy. They had multiple companies, everything else. And, I'm not a big fan of HELOCs doing them. I usually refer them out. But there are some that are available 5 days, but they do actually do them in 5 days. But you're going to pay, they'll do them on investment properties.
Wow.
They'll do a second home and investment property HELOC. So we've been doing those because a lot of people own
Now that I can see, helps you
go
you
buy
can use
another
some of
one.
the-
Yeah,
exactly.
down payment to buy another one, right? But
Well,
you're
as
at
long-
12-13%. You know what I mean?
As long as you're taking that money and putting it into something that I think is an investable asset somewhere else, something that does make sense. I don't know how much of that is, on the consumer market is really being done versus like, tap into pay down your credit card bill or something, like those.
Oh, the problem is, with that stuff is typically if someone's got 21%, they're like,
Sure.
hey, get this equity line at 10%,
Yeah.
you can pay it down. But they usually just make the minimum interest payment
Yeah.
on that as well. It's
No,
usually a
it's-
lifestyle, whether you
Yeah,
pay things off or just ride through it.
sure.
People, it's like a zebra with the stripes, right? I
Yeah.
mean, I've seen people take out loans and cash out refis, be like, I'm going to pay everything down.
Then they go to Vegas.
I got a guy. He travels all around. He'll tell you about his whole life on Facebook. This guy, he's came to me with problems, and I'm like, what are you doing, man?
Yeah.
You said you're going to pay this stuff down.
Well, we always make the joke Tampa's like the home of the $30,000 a year millionaire.
Yeah.
Like they make 30 grand, but like when they go out, you would have no idea that they're not a multimillionaire. But they only go out one day a week because that's all they
with,
look for.
with inflation, it's not like the $75,000
Right, yeah.
millionaire.
Yeah.
There you go.
We used to, when my boss up north used to call, he said, you see these people driving these Lexuses and everything else. He's like, you can live in your car, but you can't drive your home. It's like, so people are buying all these big cars. But I'll tell you that when I was younger, you're talking about, people acting like the millionaire making inflationary $75,000 a year. So when I moved down here, I was like, I got to start networking more, and everything else. So I joined the Tampa Club back in the day. Because, Palmacia took forever to get into. That was above
Still
my
does.
head. I'm 30,
Yeah.
I'm 30 years old. You guys are young bucks. But, I mean, that was the easiest way for me to start meeting people. They had an under 40 networking group and everything else, right? So you go in there, and it's a little different than it is now. It had the old school, like, dogs and playing poker pictures, 100 green chairs,
Yeah.
So
It was a man's club.
it was a man's club, right? So we went in there, and then you'd meet these people, and I'm not obviously not gonna say names or anything else, but you'd make your connections, and you go to do their refi or their purchase money, like, holy shit, like,
Yeah.
and they would treat the staff like crap there. Like you couldn't, they wanted to feel important, and everything. It was
Yeah.
just kind of like back then. It was kind of weird to see, but it was people that had to keep up with the Joneses kind of mentality, and weren't able to do that when
Yeah.
when you look under the covers. You're like, what are we doing here?
Yeah. Yeah.
I
Well,
don't think it's like that as much here anymore, is it? I live up in Odessa now, so
I mean,
it's-
I think that it definitely is still, to a certain level.
I think
anyways.
there certainly is. And to me, I think there's an interesting aspect of like there is really a true influx of much higher paying jobs and more money coming into this area.
yeah.
And again, I think this is a little more micro level than macro, of course. But I think there's almost an element of like, if you've been here, you're used to certain price points on things,
Yeah.
And now you've got these people that have flooded in since COVID, and they've pushed things up so quickly where, like, if you aren't used to that or you can't truly keep up with it, that's a steep curve to climb.
Like what kind of things you talking about? Like,
I think housing prices.
Yeah.
I think, like, you brought up Palmacia. Like, we just had the membership meeting there, and like the initiation fees have jumped significantly on that. I mean, for something that was pretty steady for a long time, and like, but there's such a flood of people that have interest in that type of thing and have disposable income to do it.
Just
yeah,
raising it so that they basically
Boom.
they'll take the
Yeah.
cream of the crop,
Yeah, and so like I mean,
cutting down on the Jessies.
hopefully not, because that's what keeps you going back, But and you talk about just, I mean, like everything, inflation. You go out to dinner, it's more expensive. But I think you have more of these high end restaurants than I think you do of like just sort of like the mom and pop starting up. And so like
Yeah.
even though it might be more expensive no matter what, you're talking about a different level of dinner that you're going to now. And so like all those things crunch you. And I think, if you were used to things here and you were comfortable with here and now they're here and you got to bridge that gap, that becomes a little bit of not a little bit, that is a strain on people. So
Yeah, it's higher end stuff coming in down
Yeah.
on Water Street and the Addition, and that's what's the restaurant in the Addition that there's only one in New York and Miami. The
Michelin, What is it?
It's like I haven't eaten there yet, but I've heard good things.
Yeah.
About it. Is it like a Greek restaurant, right?
I don't know.
Lilac? That's what it's called, I think.
Maybe, yeah.
Yeah.
Yeah, but no, I know what you're saying. They're
Yeah.
catering. I mean, it's becoming a real city.
Right.
Yeah.
I mean,
you go
back
down
when
there.
I moved down here, when milk was a nickel. you know,
You walked uphill both ways
Yeah,
to
right.
school.
Yeah.
in my sandals. Yeah. So,
In the
but
snow.
I mean, Howard Ave is like kind of where you
Yeah.
went, Hyde Park, and then there
Yeah.
was no. I mean, that was it really. St. Pete wasn't a thing, at least not that I knew of. And everything's expanded. Everything's changed. No one was downtown at night, everything else. But
Right.
I guess we're getting off point.
Well, no. So this mastermind we went to last week, they had a panel where, it was kind of a variety of different professionals, but they said I think the wrap up question was like, if you had one thing, like tidbit of information you could share, like what would that be? And the one lady that's a big multifamily said, invest in Florida. And to your point, you read that article. I mean, people are moving to Florida from a lot of the, typically from the Northwest, or the Northeast. You're seeing a lot of people from California. I mean, California is having a huge decline, I think, in their population because.
Well, and that lady's portfolio was largely California. Remember they were like, we're looking at that is their alternative to California now.
Yeah,
So,
and I say this all the time. Like, if you live in San Francisco and you work at Walgreens or the grocery store, where do you live to go to work? Because even in like a studio apartment is $1.5 million there. If you're buying it. So I can only imagine what the rent is. And so, I think you're starting to see, that area and really all over some kind of more creative stuff. I don't know if have you heard of pad split?
No, is that for?
It's a really interesting model. I mean, I actually got a little bit deeper information on it, in the last week. But basically, like you take like a 4-bedroom house, for example, and like the dining room you convert into a bedroom, the living room you convert into a bedroom, and the only real common space is the kitchen, and you just rent each room weekly.
It's like a city type co-op type thing, I guess.
Yeah.
You know what's going to be interesting to watch with that, though? I was talking to a guy about that the other day, and he said the one thing he's learned is that so they'll buy a property with hard money with the intent of refinancing into a longer product, and then they will do this pad split model on it. But what he ran into on one of the few early ones is he's like, we bought it with hard money. We went in and we did the work to make it into a pad split. And he's like, and then we go to try to refi it on a longer term.
Yeah, it's not set up like
a
house.
Yeah, he's like, these appraisers come in and they're like, what the hell is this? We don't have any comps that are a 10-bedroom on something that is like 2,000 square feet or whatever.
Yeah,
so,
they always want similar comps for the appraisal to fund the deal.
So from a financing perspective, it's kind of interesting to see like what. And I do think the financing industry does a pretty good job of like having to adapt for market trends. And maybe you feel differently about that, but I think generally they do a pretty good job. And I'll be interested to see if something is created around kind of that product so that it's not just because this guy's solution is he's like, I'm making so much money on it. I don't really care what my loan product is. Like if I have to just keep it in a bridge loan, he's like, until something happens or I sell it, fine. But if you didn't have that option,
unless he has the private money that we had on the Ola property,
yes, exactly.
then sure you're not allowed to keep the loan.
So where's this house? In this area?
They're in this area,
Florida?
yeah. But the whole idea, of course, is you go in and instead of having 3 or 4 bedrooms, you maximize common areas, and then you share the true common areas, and they do them on like I think I've got a couple clients who are like weekly on them. Well, some of them are longer term,
hourly.
I haven't seen hourly yet, but I'm sure there is some of that goes on. So, but
well, it sounds cool. I get the concept. It's the other thing about it though is you've seen other places trying to get rid of Airbnbs out by the beach. You know what I mean, and everything else because the people around it. Yeah. It's not even an HOA, right? Well, the condos are, but I mean even short-term rentals. Like was it Treasure Island? I forget which was down there, but I wonder how long that's fine if you're buying it in the city. Yeah, I think you know what I mean. But I don't think you can do that somewhere.
Well, it almost seems to me like the beach trend, and you keep up with this probably a little more than I do. But the beach trend for so long was, no, we're cracking down on this. And then I heard recently that a few of these that were like, you could never even thought about doing that before. Now have, I mean, they're tight. You got to be within their restrictions, but they're almost being forced into creating some type of scenario where you could do it.
Well, I think that part of it is you have to it needs to be a win-win for everyone, right? So like if you have an Airbnb and you're allowing people to party and, go crazy, it's not good for the neighborhood. It's not good for your property either. And I can see where people are going to crack down. But, we had a guest on here a while back talking about Airbnbs, and he made a good point saying when you're going to get into that space, you have to really view it as you're in the hospitality business, not in the real estate investing business. And so I think that part of that is creating that environment for your guests, but also the environment for the neighborhood.
Yeah.
That's why I'm running paper towels at 9 p.m.
Right,
on
yeah,
Friday night.
exactly.
Single ply.
Yeah.
So, well, the other point to that too, I guess you
save
got to
that
think
money.
about what's that?
Got to save that money.
Can't hide money. So the other point to that, I guess, would be, a lot of these people bought these properties just for Airbnb, right? Yeah. So if you stop that, they're going to freaking go under, right? And then all of a sudden the values are going to come down because you got foreclosures in your, I don't know. I'm just saying there's got to be a happy median, I guess. But a lot of people, they were talking about that coming if people shut down on these Airbnbs.
What did New York do? Have you followed
Well, they
that
have
at all?
like the hot dog stands in New York. There's a
Dirty
certain
dogs.
number of permits. So essentially, they're changing it to that model. Like, there's a certain number of permits available for Airbnbs. So you're
That's
registering. You're registering for the city. Well, a lot of times, what they're looking at it is like the hotels pay a hotel tax.
Yeah.
And Airbnbs weren't for a long time.
Not a lot of hotel room left out there in New York right now.
Yeah, I know. Yeah, not any. Yeah, exactly. That's a whole other issue. Yeah, the whole other issue. But I think when you're actually obeying like whatever the local tax laws, et cetera, then they're okay with it.
Yeah.
So I think there needs to be, the regulation. I don't think is all bad.
Right.
But
You got to keep some people in line, but
yeah. And then there's areas that, like neighborhoods that are pretty much all Airbnbs.
Right.
Which is probably the most optimal scenario, but that's not, overly realistic, I think, in most areas.
To your point, I do think it's interesting to watch. Like, I'm always leery about these stats you see online, but I saw something that was talking about the number of short-term vacation rentals in the city of Austin versus the number of available homes for sale. Okay. And it's staggering what the difference is. Like the number of vacation rentals is significantly higher than it is on the number of homes that are for sale. And,
because rents are so high?
Well, I think you have so many people that got into that market of short-term rentals and saying like, we're going to, it allowed them potentially to maybe they buy a second home and they do that on the side or whatever the reason was that they got into it. But it's just been so flooded and you have so much inventory in that side of it. But, the catalyst event, I think, is almost like how do you stop pricing going crazy? It's a simple supply and demand issue. So I think you're right. If there is a catalyst event that forces some of that back onto the market, now you've eased some of that supply issue that you've had, and maybe you do see some pricing changes on things. So.
Yeah, it's interesting. It's just a lot of people buy these based on the Airbnb rental incomes instead of what you can get on a 12-month lease.
And we tell everyone, like in our course, if you're going to underwrite an Airbnb, underwrite it like, does it cash flow if I have to do a 12-month lease on it?
Stress test.
And if it doesn't, then you can't buy it.
No, you advise them to at least have a 12-month history with the Airbnb?
Well, so we use AirDNA typically for our metrics, which I think seems to be extremely accurate. I mean, the banks for like, if you're going to do a DSCR loan and it's going to be a short-term rental, they actually will allow the Airbnb.
Yeah, certain ones let Airbnb with a history of it typically.
Yeah, but I mean, if it doesn't cash flow as a long-term rental, because if you buy it only for an Airbnb and
that's
then
the problems could be.
They say, hey, listen, you can't do it anymore. Now you're.
Well, I think the one we just did, they forced us to give comparables on long-term rentals too. Even though they knew we were going to short-term rent, they wanted a
1007 a rent schedule.
Well,
for the area.
They wanted information basically about what would it long-term rent at, because they want to make sure obviously that there's that option and it can sustain at that level too.
Yeah.
So.
Which is interesting because you remember that DSCR. We're talking about the DSCR product. They want like a 1-to-1 ratio, or higher. You get better pricing, 1.15. But now there's some that don't require any minimum.
Yeah, I think when we were browsing, there was one that was like a 0.8.
Oh, but now they go down to 0.8. That's, Orion Funding has different ones, but
I mean, what could go wrong with that?
nothing, you know. Put a negative AM loan on there and you're good to go.
Yeah,
No,
I mean, it makes total sense.
but now there's some that don't have minimums. That just came out. But I will tell you from an investment standpoint, I just signed up with a new lender. I just got there yesterday. Pretty sure you got to live on one side, but they're doing 100% duplex financing.
Wow.
If you live on one side. So that can also help offset some of the higher rate costs for people.
Yeah.
And it helps people get their foot in the door in investing, you know.
Literally.
Yeah. And at least half the door.
So, yeah, I mean, I love that, and that's why we wanted you to come on. Was just, you know, wealth of knowledge and in different financing options. And
Well, one thing you were just saying earlier, we were talking about, hey, if you like how the market kind of evolves itself when there's a need, right?
Yeah.
And I totally agree with that. Not Fannie Mae, Freddie Mac,
Sure.
FHA, any of that crap. But if there's a need for something, that DSCR product blew up in 3 months. You know what I mean? Because like, hey, how can we get these investors, make it easy? Rates are going up. They're going to be just as competitive with the rate as conventional, and then everybody has it, right? And before that, it was the bank statement loans. You know, you get the bank statement loans that you can use for investments and everything else. Well, mostly primary on that, but bank statement loans for people that write off everything, that own their own company. I mean, you're right. The market adjusts and has a niche for, you know, anything that comes to play. So I do appreciate that, and I do see that.
yeah.
It's just that they make it tougher and tougher on jumbos and fannies, these loan level pricing adjustments. Mm-hmm. By the way, I ran one this morning just before I came in, so I could be up to date on it from yesterday. Because yesterday was a pretty good day. Rates bounced back a little bit, but
It's a live market, right?
it is. Literally yesterday, I had to lock one, and we were gaining. And you know how it is. It's rates go down like putting a rubber band over your finger, and then that's how fast they go up, right?
Sure.
And then you can't lock in between until the dust has settled, and you got to do your job here. But the best part is, or the worst part is, you don't really know because they don't really know what's going to happen in the next 45 minutes. So I get it every 5 minutes, so I'm refreshing until, because I got to get 23 to 32 bips for an adjustment. So I'm watching it's at 19, it's going up here, and then once it plateaued out, I called the bar. He's like, lock it. We locked. And so, you know, you got to really keep track of the live market. Instead of every 5 minutes, I think I'm thinking of upgrading to live. But
It's like an auction.
yeah. It's like, you know, well, literally it is, isn't it?
So let's switch gears a little bit, because, you know, kind of in closing, the one thing we've always respected out of you is you have a really good work-life balance. So we talk a lot on this
Not
podcast.
sure my wife would agree.
Yeah. Wait, you're going hunting again? What the hell is going on? But, you know, a lot of times we talk about legacy and what that means, you know, and I think you do a good job of still carving out away from the office the things that you love to do. Your family's important to you. So talk a little bit about what the legacy piece means to you and how you...
Means everything. I saw a guy talking on I have a daughter and a son. My son's older, 18 and 16. And, you know, this guy was saying, he said, do you want to define success? He said, you can define success by your children wanting to hang out with you when you're an adult, when they're an adult. And, you know, I'm just learning about this because my son just went to school this summer, right? I've had people ask me, you know, how do you, maybe a little pat on the back, whatever. My son and I are very close. My daughter and I are very close. And I think I've done a good job because I was super involved. I would leave the office. I coached his football team, the Hurricanes, you know, head coach a couple years, coach 5 years, right? And I took the time at 5 o'clock, 5:30 to be there, you know, 4 days a week. And did I lose money on it? Yeah, I lost money. People probably, you know, but it was more important to be there. My daughter was a cheerleader there, and my wife was coaching them. So it was kind of, we all kind of hung together. Family, just basically putting in the time with your kids is just amazing. You know, and they respect it and they get used to you. That's why I started hunting more. You know, my buddy Christian got me into hunting years ago. But when I got my own hunting camp, selfishly, it was so when my kids got older, they'd want to come up to camp, ride ATVs, go fishing, you know, shoot bows, whatever, you know. So basically, you know, you got to basically separate out what you want with a family. If you have kids, even if not, you need to rejuice yourself, you know, because I found when I was up in Philly, you know, I wasn't married, and I worked one time from January 1st to April 14th, and Amy was living with me, and she got a second job because I was never home, and I found myself getting kind of angry at my clients and snappy. And you know why? It's because I was burnt out, man. You know what I mean? Like, you got to take time to decompress and re-energize yourself. And, do I sometimes take off a little too much, on a Friday afternoon? Yeah, but I got my laptop with me and my MiFi, but I will go hunting on the weekends. I will go out on the boat fishing and take the kids out, my family, or my friends. I like to have fun. You know what I mean?
Yeah.
Well, I think the success piece that you're talking about, you have to have what that is for you, because otherwise, what are you working for?
Right. Right. It's like that Oliver Anthony song. You know what I mean? Like, you're going to work all day and then...
I thought it was really interesting. One of the speakers at the mastermind we were at this week quoted Sam Walton, and I had never heard this before, but apparently some of his last words were that he got it wrong. And I mean, you're talking about somebody that achieved the absolute epitome of financial success, but when I looked into that a little bit, it was like he didn't have a relationship with his kids, didn't know his grandkids, which, I mean, it's funny because they're all living off of those trust dollars.
That's probably what he thought was how he was helping them instead of being part of their lives.
But I mean, that is such a good message that you have there, because you don't want to end up like that, where it's like, you get to the end and you're regretting what you've done because you overlooked the stuff that really matters.
I'm always going to have some regrets, right?
Yeah.
Just not on that side. But I'll tell you, we sit pretty close to each other, the lightning games, right?
Yeah.
So when my kids were young, they like hockey. So I got season tickets, or half season, whatever it was. And we'd go to the games and spend time. It became time with the kids. And we spent time with the kids going to hockey or whatever it might be. And then on a different level than that, right? As a man, I'm 52. I can't believe that. I don't know what I'm going to be when I grow up. But
You look 22, though.
Yeah. And
You act 22.
I act 22. But, I got this hunting group. I don't care if it's a fishing group, whatever you're into. It's like a fraternity. I was just showing you this morning, my buddies up there.
Yeah.
I got 10 guys that I can depend on, crack jokes with, get made fun of. Every day there's a string, and I just enjoy their company like brothers, man. And it's important, I think, whether you're female or male, to have that little group that you can be honest with and decompress and kind of maybe get some advice or laughs. It's super important to me.
Yeah. Well, and you were saying, when we were talking about quotes and stuff, I don't know if you remember this one, but this guy had, kind of gone through a roller coaster of ups and downs in his life. And he said the quote that he literally lives by every day is, "A man with no wealth has 10,000 wishes, and a man with no health has only one."
Yeah.
Yeah.
And I think that's a part of it too. When you look at the legacy piece,
Yeah, that's huge.
And that was super powerful to me, because I'm like, you know what, you're right. Everyone, like Sam Walton, all the money in the world, but man, I wish I had more time now to go back and spend it with my family or whatever that is for we always tell people your legacy is your legacy. I mean, it could be anything. It doesn't have to be in a box that's, society's norm, but you have to have some definition around it, I think. Otherwise, it's going to be very difficult to achieve a lot of success if you don't really know what you're working for.
Yeah, and then the key is to have them pass it down.
So along those lines, let me ask you one question before we go. You're at this kind of what I think is probably going to be a really fun point for you with your son heading off to college, and he's hitting this point where he's got his own independence starting now, and what would you say your best advice to him as he picks a career path and starts thinking about his future as far as his own life and trajectory would be?
So he knows that, on the social side of that basically he would eat 3 meals a day when he was doing football, and then come home, he'd eat dinner before we leave, and I'd make him dinner after football. And he's like, "Dad, thanks so much for making another dinner." I'm like, "You do it for your kid." I'm like, "That's what you do." Okay, I'm doing this to show you how I want you to treat your kids.
Yeah.
And we would do it that way. Now, when he went off to school, he understands that need good grades, and everything else, right? And, he's already applied for an internship this next summer. He's like, "This is so easy," because I got to do something. So he knows to work hard, right? And he sees that I have fun with his Uncle Greg and stuff like that. And we're like, "Look, work hard, play hard," right? You don't get to play hard unless you work hard. And he kind of gets that. He's starting to feel himself a little bit at school, but he gets his schoolwork done. But if you get into a business, it kind of goes to your investment side. The one thing I would tell him I would have done differently is if you're going to go into business for yourself, you need to have some pillow money or residual income. You know, the one thing, you know, I do well, you know, or whatever. I love my company, but I have to go out and close deals every week. You know what I mean? And my company is not worth much to somebody else because people buy me, you know? And it's, I mean, you can buy a roll of clients from 20 years. No one says they're going to use you, you know? But, you know, I'm advising him, you know, to basically, if you're going to go into business by yourself, something with pillow money, you know, but always trust in yourself. He's a good kid. He's well adjusted from hanging out at camp with adults. And,
but it's got to be one of those proud moments for you seeing him. You know, like it's a testament of how good of a dude you are and how great of a father you've been to see your kids turning out.
They're hard workers.
Yeah.
Grace just got certified for swimming at water seal, the watermelon seal club, or it used to be swim seal. She's worked with ESE children ever since she was in kindergarten. She's a hard worker. She babysits. You know, these kids, I have faith.
She babysat my kids.
She babysat your kids. They're alive, right?
That's right.
So
still here to tell the stories.
But I have faith in these kids, man. You know, I think some people might have lost their way a little bit. Not judging, but it just seems like some of the core want to work and strive. Maybe it's because of who they hang out with. But these kids are pretty driven right now.
That's
so I don't know if that answers your question.
It does. No, I mean, that's part of why we love doing this. Is it's like it's as much as the investing and the work and the you know financial side of it, but like I think at the end of the day, what really brought us together and wanted us to do this was what we're just talking about here. Is like how do we set ourselves up so that we're maximizing what we're giving to our kids and to our own legacy and how that flows after us.
Yeah.
So,
no, I love it. I mean, it's not just about money. You know what I mean? It's,
exactly.
This is how I want things done. This is what I want you to be. And that's, you know, you raise real human beings.
Yeah.
You know?
Well, we appreciate you coming on.
Yeah.
I think it was some
great having. Thanks for having me.
Mm-hmm.
Here in the Legacy Wealth Code Studios.
That's right.
You know,
10th floor.
Right. All right, guys. Well, until next time, this has been the Legacy Wealth Code Podcast. We'll see you soon. Onward.
Thank you for joining us for another episode of the Legacy Wealth Code Podcast. If you enjoyed this episode, click subscribe now and never miss an episode. Until next time, onward.